Yeah. Okay, welcome everyone. I hope you grabbed lunch, pizza. My name's Madeline. I'm the community engagement specialist here at Cambia Grove. I see some familiar faces, some new faces, so that's super awesome. We're super glad you guys came. If anyone has any questions about Cambia Grove and like what we do, using the space, our events, our programming, please feel free to approach me after the event. Approach Riley or Rasham that are up at the front desk. We can answer any questions you guys have. One note about Lunch and Learns. The topics that we choose for these Lunch and Learns are actually chose by Echo Health Ventures. So really, they're the experts. They're the ones who try to identify those barriers that they see when they're talking to startups. So they're really important topics. So we definitely appreciate you guys showing up. So without further ado, here is Tyler Holenbeck from DLA Piper to talk about term sheets.
Awesome. Thank you so much. Yeah, thank you for having me, everyone. So you all probably see that Kurt is not here from Echo Health, so I apologize. Not having the actual investor with the checkbook is disappointing, I'm sure. The lawyers, we have lots of information, but no dollars. So hopefully I can still be useful. Kurt and I were going to do more of a dialogue and then make it, very Q&A based. But since he's not here, I thought I would start with, a few minutes, maybe 10, 15 minutes of high-level thoughts on, the topic and most important issues. But I could honestly talk about term sheet negotiations and optimizing term sheets for many, many hours. There's a lot of different directions that this could go. So I think I'm going to keep my thoughts pretty brief at the outset and then kind of turn it over to you guys to see what direction people are the most interested in going, and then we can tailor the discussion more as a Q&A and drill down on things that are of particular interest to you, if that works okay for everybody. But so at a high level, and I guess to introduce myself a little bit more, Tyler Holenbeck, I'm a partner at DLA Piper. DLA is one of the biggest law firms in the world. We have coverage in every major city around the world, but our Seattle office is pretty small, and it's pretty largely focused on the transactional side on technology companies, and then on the litigation side on more commercial and securities litigation. My practice is all emerging growth and venture capital based, so I work with either venture capital investors or the companies in which they invest, and it's all high growth, in the tech field. Much of it, I do a lot of life sciences work, but not exclusively. So negotiating venture term sheets is probably 20 to 30% of my job. So I do a lot of this and have been doing it my whole career, and have done it on both, like I said, the investor side and the company side. So I think I sort of bring both perspectives to the table. So, at a high level in terms of optimizing your term sheet, I think a lot of times people think, well, the investor will give me the term sheet and then I negotiate it from there. And that's true, certainly in most cases, but there is some advanced directing that you can sometimes do with your investors as you're talking to investors. And so knowing ahead of time what your optionality is and where you might want to try to be steering people if you have that kind of leverage to sort of land the plane in the optimal place can be really useful. So, that's the first thing to keep in mind. And I assume most of you, I see some familiar faces, and so there's some things that I think a few of you have heard me talk about before, but I assume most of you are at the sort of seed or early A stage. And so at that stage, one of the biggest initial inflection points is, can you take in dollars on some sort of a convertible instrument, either a SAFE or other type of convertible security or a convertible note itself, or do you have to do a full priced equity round? And that's a conversation that you can direct early in your discussions with investors. And, to the extent that you have leverage and you can play, competition amongst investors off of one another and you can steer them in the direction you prefer, that's one major sort of inflection point at the early stages. And the advantages, as I'm sure many of you know, of the convertible security or convertible note approach is that the legal costs and the speed to execution are lower. Significantly lower in the case of a SAFE, because that's Y Combinator's. It's a branded form of convertible security. The SAFE doesn't have any magic. It's just a convertible security, but it's YC's branded form. But because it's so templatized and it's now sort of widely accepted as as fair and down the middle, there's essentially no back and forth if you can get your investors to agree that they're going to use a SAFE at this discount or this valuation cap. And so your legal costs can be way, way down and your speed to execution can be much faster if you get investors to agree to a SAFE. A convertible note or a non-branded type of convertible security have slightly more cost because it's not a standardized, off-the-shelf form. So there's going to be some drafting and some negotiation involved, but the universe of issues in a convertible is significantly lower than in a full-priced equity round. So your speed to execution and your cost is still going to be much lower that way. The downside of the convertible, as opposed to the priced equity round, is really a downside to the investors for the most part. It's that they don't have the full suite of rights. They're not stockholders when they buy a convertible instrument, and they don't have the traditional preferred stock investor rights that include board seats, protective provisions that give them negative controls and blocks over certain material actions of the corporation, registration rights, preemptive rights. There's a whole host of other issues that go with a full priced round. So from a company perspective, raising the convertible early on is largely preferable. The downside is maybe you get a little less engagement. So if you're raising a very large round and you have one large anchor investor, having them on the board, having them be deeply engaged with all of those rights can be useful. And venture investors, if Kurt was here, this is one of the questions I would pose to him. Venture investors will always say, no, I want to be a partner. I want to be involved. We have operational experience. We have connections. We have all these things I can give you. And if I'm not, at the board level and, in the middle of all of this, you're less likely to have that dialogue. So there is a downside to the company of going the convertible route. If you're raising a large round and you've got one big anchor investor, they're potentially a little less engaged in that scenario. But you have the upside of speed and cost and lack of all these controls and rights. Of course, from the investor side, that's a different calculus, and what your investor is going to be comfortable with, I think, depends very much on who the investors are, where they're geographically located in some cases, what their sector of investment focus is. So, for example, in the pure software investment space, let's say take Silicon Valley as an example, the market is pretty much coalesced in at the seed stage around safes being an acceptable form, and you're going to be hard pressed to find an angel or active early stage investor in that market in the software space in the Valley that's opposed to that. Seattle's been a little slower to come around. There are still angel investors here that are more reticent to the safe or the convertible that push for a priced round even in small rounds. I think those people are becoming fewer and further between, but they still exist. And then across sectors as well. So as you move out of software and say in life sciences or other in other sectors where the capital requirements might be bigger, you get a little bit more resistance to those smaller convertible rounds, and you might get pushed more into a priced round. So we can dig much more into that if that's a topic of conversation for everyone, but that's sort of your first major inflection point. And then the other, let's say you get pushed into a priced round, the main sort of three topics that I think get the most attention and the most can be the most front-loaded in your discussions and negotiations are valuation and liquidation preference, which have all the economics essentially built into those, and so that's going to dictate ownership levels and returns in various different exit events. And those are pretty easy to talk about. There's only valuation is, I shouldn't say they're easy to talk about. Valuation is really hard to come up with, but it's an easy thing to talk about because it's a number that dictates the ownership percentages, right? So it's pretty easy to have that discussion without a lawyer and a full-blown term sheet. Similarly, liquidation preference, there's only so many variations, and I can talk a little bit about those in a second. And then so I think of full-blown venture term sheets in two sort of buckets. There's the economic terms, and then there's the control and governance terms. And probably the most important by far and away of the control governance terms is board composition and who's sitting on the board and what sort of board representation the investor has. So those would be sort of the top three if you're thinking about before a term sheet comes in, as I'm meeting with investors. Let's say I know that I'm going to get pushed towards this priced equity round. What kind of three terms do I need to think about and pay attention to the most in my early conversations to get some directional indication from the investors? I would say those are the top three. There's certainly lots of other things to talk about, and we can go into other things in much more detail depending on where the interest of the group lies. But those are three very important top-line issues. Another thing to consider that you can start steering at the outset is whether or not you're going to agree to start from some form set of documents. Again, in the interest of keeping your legal costs down and speed to execution, you can minimize much of the negotiations if the parties can generally agree that as a baseline we're going to start from X, Y, or Z forms. And the legal market has shifted a lot over my career over the last 12 years, and people have recognized that there's competition and we've got to bring costs down, especially for early stage investments. And so coming up with sort of open source, universally agreed upon templates is a good way to do that. And so there's sort of two, main, most commonly used templates. There's others out there, but there's the SeriesSeed.com investment documents, and those are a much shorter form set of investment terms. They're more company favorable. Some investors don't like them because, again, they don't have the full suite of rights, but it has essentially what people have agreed are the core, most important rights for an earlier stage, smaller seed doc. And they're drafted in a way that just sort of streamlines all the negotiations to one place in the documents. And so the number of sort of changes that your lawyers have to draft into it and that the other side's lawyers have to review is pretty minimized. So you can keep your costs down a fair amount by using those docs. The problem with the Series Seed docs is that they aren't on the full-blown suite of normal venture capital terms. So when you go to do a bigger round, let's say you go to do your Series A round, you have to start from scratch effectively and blow those documents out and go to the full suite of docs. So you're going to incur more costs at the A than if you would have gone with a full-blown suite of documents at the seed stage, but you've deferred that cost a little bit. So there's some value to that. And then the other, sort of universally recognized set of documents is the NVCA, the National Venture Capital Association form investment docs. And you, as a company, you're never going to have a hard time getting the investors to agree to start from those docs. They are, on the investor favorable side of things. If we're talking, most company favorable terms is a 1, most investor favorable is a 10. I would call the NVCA forms kind of a 7. Maybe you can modify them down to a 6.5 kind of thing, but they're tipped a little bit on the investor side. So, as a company, you need to understand and work with your lawyers to understand what all those terms entail. But if you're comfortable with that and you just really want to move speed to execution, saying, hey, can we just agree that we're going to start from the NVCA forms and we need to negotiate around these few issues, but generally these are going to be the templates, and then direct your lawyers to use those as the templates, that can really speed up speed to execution. There are some lawyers and some law firms that are very proprietary about their own forms, and so you can get some pushback in that scenario, but ultimately you guys are the clients and you control, and the investor can dictate it as well and say, no, I don't care about your proprietary forms, X, Y, and Z law firm. I want to use these forms so that everybody's sort of starting from the same playing field. So I could talk a lot more about various different terms, but I kind of want to pause real quick and just see, I don't need to go around the room because I think that would take too long, but I want to understand, are you more interested in learning about specific terms and negotiations on valuation, liquidation preference, other things, or do we want to talk more about the divide, between convertibles and priced equity rounds and how you can manage those discussions and those negotiations early on? We can certainly try to do both, but like I said, we can go deep down a rabbit hole on all these different things. So I might pause for a second and try to start taking some questions and see directionally where folks want to take it, and then we can proceed a little bit further down those paths. So anybody have anything that I've said? And if nobody has any questions yet, I can keep talking about specific terms and valuation specifically, if that's the best use of the time.
Yeah.
Talk about valuation?
Yeah.
Okay, cool. Well, that's easy. All right, I'll keep talking. So in terms of, valuation is clearly the number one thing that people pay attention to and negotiate in terms of in term sheets. You've probably heard people say this, but it's incredibly difficult, basically impossible to value early stage companies. Traditional, discounted cash flow metrics and all of that is all nonsense, right? At the early stage, there's too many variables, there's too many unknowns. So at the end of the day, what valuation comes down to is a supply and demand issue. And it's what the markets will bear. And so you have to understand your leverage and try to maximize it as much as possible, so that even if the supply and demand isn't totally balanced, there's the optics in the negotiation that it may be. And that's a delicate balance, because you don't want to be untruthful to the investors that you're talking to. So you want to maintain your credibility, but there are ways to manage that leverage a little bit. What's coming in the door, what's around the corner, what other investors are you talking to, without making it obvious that you're trying to improve your leverage by intimating that maybe a higher valuation is coming down the pike. Valuation. So really, it's a supply and demand, it's a leverage question. There are some metrics, and I'm sure you've seen them if you have PitchBook access, or if you've seen any of the PitchBook data. There are certainly, ranges and percentiles, quartiles of, traditional valuations in different markets and different sectors, and those evolve over time depending on market conditions. Generally, I don't find those to be particularly helpful because each situation is sui generis and unique based on the leverage and the negotiation terms and the supply and demand for that deal. Your sector may be hot, but you may be a first-time entrepreneur, and the company you may be comparing yourself to may be a repeat entrepreneur who's had 3 successful exits. Your leverage will be worse in that scenario than the repeat entrepreneurs. Vice versa, if you're a repeat entrepreneur, your sector may be a little bit, less sexy and might have lower valuations. But if you have investor connections and you've built up a rapport with them and had successful exits for them, your leverage over those investors and the supply and demand for your deal is going to be hotter. So there's all these factors that are independent of geography and sector that come into play in that supply and demand dynamics. And I think you want to think through as you go in to the discussions and the negotiations as many of those factors as possible. And you can look at the PitchBook data and say, okay, Series C deals in my sector or, in Seattle are pricing it between a $5 million valuation and a $15 million valuation. Where do I land on that? Well, how hot is my sector? What are my contacts? Do I have a putative lead that's sort of a front runner that I can play off of other folks, to try to increase my leverage? You should go in with eyes wide open about what your leverage is, because that's going to be the number one driver of the valuation that you can obtain. So that's sort of how I think about the negotiations on valuations. Then there's sort of a technical component below that, which is that pre-money valuation is not an objective legal concept. There's no black and white. It's not a clear, this is what pre-money valuation means. Pre-money valuation is a fluid concept, and there are ways to manipulate what goes into the pre-money and what does not that can change the comparison between 2 different offers at 2 different valuations. So I'll give you an example. Probably a lot of you have heard about option pool increases and whether an option pool increase goes into the pre-money or the post-money valuation. So when investors come to invest in a company, they're going to say, okay, we're going to put in this much money and we're going to do it at a valuation of X. But before we make that investment at a pre-money valuation of, let's call it $8 million, we want you to increase your available option pool so that after our money comes in on a post-closing basis, the total available pool is 10% of the company. So 10 to 15% is fairly standard at early stages. And the reason that they do that is that they say, you need to have sufficient available option pool to go operate on the hiring plan that you've laid out for me and to hire all these other executives and salespeople that you want to hire to go scale the business. And that's not my problem. I shouldn't be diluted for that because you didn't reserve a big enough pool to begin with. So you're going to increase your option pool so that your total number of shares that are available before my investment at my $8 million pre-money valuation is sufficient to execute on your hiring plans post-closing. Well, what that does, so the way valuations work is, let's say you have a $10 million pre-money valuation. That gets translated into a price per share that the new investor pays in the round, and that price per share dictates how many shares the new investor's money buys. So if the new investor is investing $2 million on a $10 million pre-money valuation, and there are 10 million fully diluted shares outstanding, the $10 million pre-money valuation divided by the 10 million shares gets you $1 per share. They're going to buy 2 million shares for their $2 million, and they'll have 2 million out of 12 million post-closing. If you add into that pool, or if you add into that $10 million fully diluted denominator that gets divided into that $10 million pre-money valuation, another million shares into the option pool to get to the sufficient option pool size, all of a sudden now the investor is buying, I can't do fast math, I use bad numbers that I can't quite get to, but you'd be $10 million pre-money valuation divided by $11 million 11 million shares outstanding, so somewhere around 91 cents or so. Now all of a sudden for those 2 million shares, they're buying, or for that $2 million, they're buying 2 million divided by the 91 cents. They're buying over 2 million shares, and now you're going to have 11 plus the 2,200,000 shares on a fully diluted basis, and you, the founder, will still hold the exact same amount of shares that you held in either scenario. You can see that your founder shares are going to be worth less as a percentage of the overall post-closing in that scenario than if they had no pool increase. So what goes into the pre in terms of what capitalization numbers go into the pre isn't actually tied legally to what is actually outstanding at that point in time. Those pool numbers get put into place at the same time that the investment comes in the door. It's not like that's actually outstanding ahead of time. It's a purely negotiated item. So there's now, with the rise of convertibles and all these other instruments that have made seed financing a little more complicated, there's a lot of different ways to talk about a pre-money valuation. The pool increase one, I use that as an example because that's sort of the baseline level setting that's been part of the venture market for 20 or 30 years. So people understand that, and for the most part, in most deals, you're going to have to increase your option pool on a pre-money basis because investors will say, it's not my job to get you a sufficient pool to execute on your hiring plans. That dilution comes to you, and then I put my money in. But you can negotiate them on what level of pool you need. And so, they might push for 15 and you might get them down to 12 by showing them your hiring plan and showing, no, I actually think based on the data, I can pay people a little more in cash, give away a little bit less equity, and I can make all these key hires and still be in that 12% range and not take a 15% pool dilution to myself on a pre-money basis. So you can negotiate on that. But I think the more important point to look out for going into the negotiations is if you have safes or convertible notes outstanding, do those safes or convertible notes go into the pre-money valuation or not? That can be a really, really material determination that can make the comparison between two term sheets vastly different. And so when people are throwing around valuation numbers, if you have convertibles and you have an option plan that isn't very large, I think it's important to drill down on, well, what exactly do you mean when you say an $8 million pre or a $10 million pre? Do you mean $8 million including the $2 million worth of safes that I have? Or do you mean $8 million and then the $2 million of safes will go in on the post? So taking that example, if somebody gives you an $8 million valuation, but they want to put all the $2 million worth of safes into the pre, your effective pre on your stock, the stock that's actually outstanding now before the safes came in, is $6 million. Somebody else offering you a $7 million pre, but putting the safes in on a post, actually a better deal for you than the $8 million pre with the safes going into that. But nominally at the top level, it looks like the $8 million number is bigger. And many entrepreneurs are moving quickly and they see, they're in discussions and they don't drill down to that level of detail. And, oh, I got a higher pre from these guys. And then they go down and do the math and, oh, crap, this is actually worse for me. So, understanding how that comes into play and asking the right questions early on before the term sheet comes in when you're having those valuation discussions. And it's not just asking the right questions, it's also making sure the investors are fully informed. What does your capital stack look like? What kind of fundraising have you done? What sort of convertible instruments do you have, so that they can also be having a conversation that's fully informed with you, and there's transparency on what you're talking about when you're comparing numbers. I've had a lot of situations where those conversations happen, they were loose, they didn't drill down to that level of detail, term sheets come across, I run a model, I show it to the client, and they're like, oh crap, this is 10% more dilution than I anticipated because I didn't know that they were going to put all these things into the pre-money valuation. So, you'll drill down to that before you get to signing of the term sheet and executing on the doc. But it's good to know at the outset, if we're talking about optimizing your term sheet, to really have that full understanding of how that valuation can be manipulated. And there's a little bit of information asymmetry. Usually the investors are more aware of this dynamic than entrepreneurs are. And so, they'll often give you a pre that includes all your convertibles so that the top line number is as big as possible, so that you're excited and you can go tell your investors, I got a $10 million pre. Yeah, sure, but it's got all these safes that you've raised built into that, and so your nominal number is a little different than your effective pre-money valuation for just yourself and your own shares. So I'll pause on valuation for a second and see if any questions on that concept, and then I can talk about other terms as well. Gosh, this either means that I'm telling you everything you need to know, or that I'm making no sense or not talking about anything of any import to you. Sure.
So what's the reason behind why it's not their problem?
Oh,
is it just a standard
pool increase?
Industry? Yeah.
Yeah, I mean, partially the answer is standard industry term that's sort of evolved. I think 20 years ago there was some discussion about whether it goes into the pre or the post, and over the past 20 years that's evolved. It's always in the pre. The argument is, what level of pool you've reserved up to this point is an arbitrary decision that you, the company, have entirely controlled. And so the go forward plan needs to be fully funded from an equity perspective before their money will come in. Otherwise, companies would always, basically set zero pool and then juice it later. So not your problem was a little bit of a flippant way to describe that. Their point is it should be at a reasonable and sufficient level before their money comes in to actually execute on your hiring plan. Did you have a question too? Okay.
Perfect.
Okay. We can come back to valuation if that's interesting. Is this still the right line of discussion, and everybody wants to sort of drill down on different terms? And was that useful from a valuation perspective if I sort of go into that level of detail on other key terms, or anything else that would be more useful thinking about the leverage? Yeah.
I do wonder, are there things that we should, as an entrepreneur, think about, maybe not necessarily trapped, but things that VCs ask for that aren't necessarily standard?
Yeah. Well, so I mean, I think if we talk about the key terms, we can talk about things that are potential traps for you. I think on the valuation front, what actually is going into this nominal top line pre is the number one trap that I see. On liquidation preference, let's go to LiquPref next. There's two concepts in liquidation preference. There's the multiple of their invested amount that the investors get back before any additional dollars can be returned to common. That's the 1x, 2x, 3x kind of concept. And then there's also a participation component to it, whether or not the preference participates or not. So a participating preference would mean that the preferred investors get their, let's say it's a 1x participating preference, they get their money back first before any money can go to anyone else. And then the rest of the money is shared equally among the common and the preferred based on the as converted number of shares owned. So in a 1x participation scenario, the preferred are always going to get 1 times their money more than the common gets, because they'll always take that money off the top. In a non-participating scenario, the preference acts only as downside protection. So the preference is returned to them if they get their money back first before any money can go to anyone else. But the only way they can get more than their preference amount is by converting to common, not taking that preference amount, and sharing in the total proceeds with the common. So the return curve, and if I probably should have, I've got a good presentation on this, but I thought Kurt and I were going to do a Q&A. But the return curve in a non-participating preference looks like, to the preferred investors, looks like, the arrow going up as you get to their 1x, so they get the first, all the first dollars in until they hit their 1x. And then there's what's called a dead zone, where they don't get any more than the 1x, because if they converted, they wouldn't yet have, or by converting, they wouldn't yet get more than that amount, so they just take their preference. And then once they get out of that dead zone, that's when their money comes. That's what investors are focused on, is what is that dead zone? What is the valuation of the company that I'm in that dead zone? And what is the likelihood that the company's going to sell in that dead zone? Because that's where you, the founder, might want to sell, and you might get some returns that are reasonable to you, but they're only going to be stuck getting their 1x back. So when they're looking at valuation and how much they invest, and as it gets more complicated, as you layer in multiple series that have different dead zones, they have their little analysts in the background running models to understand that. And so to the extent that you can also run models, and there's level of financial sophistication I know varies, and your lawyers can help you with this, although it's not always the most cost effective. But to the extent you can generally run the math and be aware of where those dead zones are, you can understand what the investors are thinking and help alleviate concerns about, no, we're not going to sell between a $20 and $50 million valuation. I'm aiming for, the home run, or whatever it is. If it's later stages, those valuations start to tick up. So in terms of negotiating liquidation preference, I mean, we've been in a bull market now for 6-7 years in the venture space, and that has resulted in a pretty strong coalescence around a 1x non-participating preference being the market standard for early stage investments. And the rationale there is that at the early stage, the venture investors are really aiming for the home run, and really for the grand slam, right? They want to hit it out of the park. They're not aiming for the double or the single. And many investors won't even invest in companies that, especially venture investors, it's maybe different in the angel community, but in venture investing, many institutional investors won't even invest in a company unless the TAM is, the total addressable market, is sufficiently big enough to justify a potential grand slam outcome. And so if that's your aim and that's your target, and I think more and more investors are seeing, especially long-term investors, are seeing that their funds' returns are made off of those grand slams, and one home run can make a portfolio, even if there's a bunch of strikeouts or singles to go along with it. So if that's their real aim, what they're interested in is investing in big ideas that have the opportunity to really revolutionize the world and have that big home run. If that's the case, it doesn't really matter what the preference is. You're all aiming for the conversion. And so align incentives and make sure that everybody's rowing the oar in the same direction to hit that grand slam. And so you can sort of flip that language on its head with the investors if there are, you know, intimations that they might ask for more. It's no, we're trying to align incentives. We're all swinging for the fences here. I'm in this for the long haul. I'm aiming for the $1 billion exit, the IPO, you know, whatever the big number is, just like you are. And you don't need to monkey with this because you don't have to worry. We're all in this long game to have a big return. Where that starts to break down is, again, in some different sectors. Unfortunately, in med tech, for example, where investment dollars have really dried up quite a bit from venture capital firms over the past 10 or 15 years, because very capital intensive businesses, lower margin, really heavy competition from big entrenched, a small number of big entrenched players. In those markets, multiples and participation features can still exist because investors are very acutely aware that everybody isn't going to have a $1 trillion exit and revolutionize the market, that you may be playing for a smaller exit, and so they need to juice their returns. They act a little more like private equity funds, like hedge funds in those markets, because they're trying to maximize their returns even in the sort of middle value exit scenarios. So I think the advice here would be to know your sector. And again, this is looking at PitchBook, understanding where the market is, and understand are you likely to get pushed towards something that's off that market standard? And if you are, how can you model out and understand where these dead zones are and what the impact of those different participation features would be on you at various exit valuations? And look, some of it's a luxury. Like the people that hold the purse strings have the control, so you have to take the most money, the best money that you can get in to fund your business. But you also want to be aware of the consequences of that and where the incentives may be misaligned. When I was practicing after the real estate crisis and in the down years in 2008, 9, 10, 11, we saw lots of non-1x not 1x non-participating liquidation preferences, because everybody was just scrambling to get their small sliver of a smaller pie. So to the extent the market turns again, being aware as you go into the fundraising cycle of what the venture market is doing and whether it's turning or has turned will also help you understand, are you going to get pushed towards something that is different than that 1x non-participating sort of, platonic ideal that's been in place for a number of years now. Maybe I'll pause again for a second on, yeah.
Can I give you a mic? Sorry, just because we're recording. So perfect. Thank you.
So you mentioned some investors require you to have a certain operational pool before they invest their money and such. And so I'm curious if the investors tend to be more business objective focused or just the predetermined capital focus, because if for whatever reason you're able to accomplish your goals, maybe you need less salespeople than you previously determined, and it didn't require as much, but you still determine a certain number. Are there clauses built in where that can fluctuate? You can renegotiate, say, hey, we reached our levels without that much capital. Like, how does that go?
Yep. So there are a good question. There are ways that you can split the difference between the two at the early stages. So Andreessen Horowitz invented a clause a few years ago that got used pretty heavily for a while, where let's say you and the investor can't agree. You think I only need a 6% pool to meet my objectives. They say you need a 10% pool. One way to split the difference is to say, the investor usually is the one driving this. That's why Andreessen Horowitz invented it. They say, great, fine, we'll give you the 6% pool, but we're going to build this clause in that if at any point in the next 3 years you come back to us and ask us to increase the pool, we're going to adjust automatically the conversion price of our preferred stock so that it converts into common at a higher ratio, as if you would have taken the 10% pool that we wanted at the time into the pre-money. So we'll just automatically ratchet up our ownership percentage. Their liquidation preference doesn't change because their dollars invested are the same, but the percentage of common that they convert into, and therefore their total ownership increases in that scenario. So yes, there are creative ways to do that. Certainly if you can't reach agreement. My advice on some of that is that there is sometimes, and this is not a blanket rule, but there's sometimes a little bit of being too smart by half. involved in negotiating a bunch of really creative provisions to thread these needles. You can increase your legal costs, you increase your complexity, you increase your friction with your investors. That's not to say you shouldn't do it if you're really truly at an impasse, but I think the better way to do it is to roll up your sleeves with your investor, and they will generally, they're going to come in with a predetermined point of view, but they're not going to be nearly as close to the business as you are. So if you come forward with a really well-researched, really backed up hiring plan with data showing, these are the ranges of equity for these hires at these levels. This is what I need. Here's why this works within my budget. This is why we can get to this growth level without hiring more than that. If you come in really well informed and present to them the hiring plan, in my experience, more often than not, those arguments are going to win, and you'll get the investor to come around at least much closer to your way of thinking than they originally would, because they're just not nearly as close to the business as you are. And so if you're persuasive and thoughtful about it, that's going to be, more powerful than trying to lawyer around all of the corner cases, because lawyers are expensive and those lawyering provisions aren't always perfect. So that it's possible, but be careful. Sure. You want to grab the mic? She's got one right up here. Yep. Very official, yes.
I feel like karaoke. I was wondering, I've got a revenue model and it's like 10 Excel pages long, and you can build up from really small medical claims data.
Mm-hmm.
But how much do average people show investors for hiring plans and revenue models? Do you want to get down into I have quoted the office floor plan kind of thing?
Sure. So I have a sort of dual answer. I think you want to have first answer is, the more thoughtful you can show them that you've been, the more credible you will be, which is important. The flip side of that, of course, is that, like I said at the beginning, it's all a little bit of nonsense and very speculative and very highly variable at the early stage. So what I would typically recommend in that scenario is that you have a simplified version of the plan and the model that you show people early on, and that as the conversations progress, you show them that it's, this is based on a lot of data, and you express enough humility to not appear foolish, that you understand that there's tremendous variability, and you build in base case, growth case, retraction case into that model so that you can show them that you're not myopic. You don't think there's only one thing that's going to happen. You understand that there's variability. And you have like I said, the right level of humility, but I think it's useful to generally show them that you've been incredibly thoughtful about it. The key, though, is to make them aware that you're not going to be dogmatic about that plan, because they also want to understand that you'll be flexible, that you'll change as you get more information and you drill down on what the business is actually doing, and that you can move off of that. So I think if you appear rigid and connected to this hyper detailed model that's probably not going to come to fruition, that can be a red flag for investors. So it's all about how you present it, but the level of detail is good. It shows that you're being thoughtful about this. Okay, I'll maybe talk about some other terms. I'll talk about board composition, and that's the governance terms. That's probably the most important. In a corporation, as I'm sure all of you know, because I think you probably all have companies, in a corporation, the stockholders are the residual owners, and they elect the board of directors, but the board of directors is, while subject to stockholder election, in charge of all the strategic direction of the company. And then the officers of the company are subject to the board's hiring and firing. So the board has the highest level of strategic control over the direction of the business, and under corporate law, either in Delaware or Washington or really in any other state, all material decisions for the business have to start with the board and have to be approved by the board. And the default rule in board composition is one board member, one vote. Now, you've all read about high-profile cases where that's been changed in recent years, where you can have super board voting power. A lot of the attention has been on supermajority stockholder voting, but that is tied then to the power to elect the directors. So if you have these supermajority voting common founder shares, that just means that you have control over the board, so then you can remove directors that aren't doing what you want them to do, largely. Snap, Facebook, Google, we've seen high-profile examples of that. What I say to investors, or what I say to founders, when they're talking about supermajority board power, supermajority common founder voting is, are you Evan Spiegel? Are you Mark Zuckerberg? Can you convince investors that you are? You may be in the future, but can you today convince investors that you are? If you have that sort of rock star leverage, great, go for it. But frankly, if you have that sort of rock star leverage, do you really need the supermajority voting power, or is your charisma and your power and your passion going to win everybody over as you ride the rocket ship to the moon? In most cases, most investors will push back very heavily on those types of structures, and you will spook a number of investors by setting that up at the outset. So, my advice there would just be very, very aware, very self-aware of your own leverage and your own position in the market before you start demanding terms like that, because you can scare off investors certainly by doing it. That's not to say I've done it before and I've had companies be successful doing it, but I've also seen a lot of pushback, including in very successful companies where the founder does have a fair amount of leverage, but the investors are wary of it, partially because of some of the recent epic failures in corporate governance where those types of structures have been in place. WeWork has really hurt anybody's chances of asking for those kind of supermajority voting powers for the next year at least. And when some of the bad stuff went down at Snap, that was also sort of a tough look. Versus at Google, it's all been very successful, and those guys have done great with those provisions. So after Google got a lot of public attention for setting up that structure, there was a lot of people interested in it, and then there's some failures and it dips down. So, but let's put aside that and talk about just board control. The basic rule is that majority vote controls at the board level. So what's really critical is figuring out who comprises a majority of the board and which classes of stock can designate those directors. I would say the sort of baseline platonic ideal, and this is not platonic ideal from the company perspective, this is more from a neutral middle ground perspective. The baseline ideal is to balance the common directors with the preferred directors, and then have an independent director be the tie-breaking vote. That way, the independent is, not all directors owe fiduciary duties to all classes of stock, but people are realistic that even if that's the legal framework that the directors are supposed to operate under, that's not always the case. And there are, if you're a common stockholder, you're going to feel a little bit differently about things that impact the common in a different way than preferred holders will. So, in a seed stage investment, the sort of baseline starting point for negotiating board composition will be one founder, one seed investor, and then one independent. Again, with the market being bullish for the past 7 or 8 years, I'd say this is the place where I've seen especially seed A stage terms shift the most in my career. As we've come out of that bear market and come into the bull market, the percentage of deals where the common stockholders are able to maintain board control even at the early stages and have, say, 2 founders and 1 preferred director and no independents on the board at the early stages has gone up dramatically. Maybe even to the point where that's a majority of the deals that I do now, or close to, because again, the venture investors have started thinking more about, especially at the early stages, they've started thinking more about aiming for that grand slam. And so, controlling the board, they're not wrangling for quite as much control. As long as they have visibility and they're sitting at the board, there's sort of mutual trust that you're all rowing in the same direction. So, to the extent you as a founder can negotiate that sort of board composition, that protects you from being terminated, right? Like if you come in and you get 1 preferred director and 1 independent, and that preferred director flips the independent and convinces them that the founder is no longer the right person to lead the company forward, the board can terminate you. Now, you can negotiate employment protections and all those sorts of things, but that starts to get, again, a little complicated, too smart by half. You can spook your investors by managing all of that. So at the baseline, in terms of optimizing your term sheets, if you can just think ahead and try to drive toward majority board control, if not in the common class, maybe you have some seed investors that are angels, friends, and family that you feel very aligned with. Their cost basis is low. Maybe you can have 1 common, 1 seed director, and then 1 A director and 1 independent, or something like that, where you feel like the majority can't be tipped against you. That's a great way to maintain the baseline control. If you can maintain that level of control, then all the other governance stuff that investors ask for, if you talk about protective provisions, that's what people often think about as the next most important governance, which is those are certain actions that are usually the most material things a business can do that can't be taken without majority preferred approval. Those are negative controls, meaning that they can block you from doing that, but they can't force you to do it. So they can't come in and force you to sell. They can just not let you sell the company until they agree to do so. In terms of inertia and keeping the status quo, usually the founders are the most interested in keeping the status quo and the inertia going forward. So those negative controls, while certainly something we can talk about and that are important, are less important than the top level, can we affect significant change, terminate the executives, sell the company off, whatever big course shifting move that might be initiated. If you don't have majority board control, you can't do any of that stuff. So all of the corporate governance kind of starts with majority board control. Pause on that one for a second. Are we running out of time?
We have about 5 minutes.
Okay.
So.
I talked about all 3 of the most important topics. So let's switch to Q&A. What did I not touch on? I mean, there's a bunch of other terms that we could drill down about, and I'm happy to talk to people, later over coffee if they want to schedule something and talk about other terms. But anything else at a high level that I could answer and talk about here? Gosh, yeah, you guys are. I'm either doing a terrible job or a perfect job. I'm not. And I don't think it's the latter.
I have a question more about geography.
Okay.
That it seems that the different investors I talk to in different cities have different terms. Are you aware of that? That people in Seattle tend to hate safes, can't even get in the room with safes. And then I was in Vancouver last week, and they absolutely love safes.
Yep.
Can you talk a little bit about that, and how can you structure your round in multiple geographic regions, or do you have to pick one and stay there? And how does that sort of play into it all?
Yep. Yeah, no, there's absolutely some geographic differences between terms. I mean, East Coast versus West Coast venture terms are different. I would say the East Coast investors are a little more toward private equity. The joke that I like to tell is that they put the capital in venture capital. They're capitalists about it, and they ratchet the terms and are trying to maximize returns. On the West Coast, it's much more venture focused. It's that early stage mentality, and so some of the things that I've been talking about, the shift in venture terms over the last 20 years, have been West Coast based. Although that pulls the East Coast as well. And then between San Francisco and Seattle, there's a delta. There's more activity. The angel investors in San Francisco see more volume. Again, not universally, there's a lot of super angels here as well, but I would say that on average, if you're comparing angels in the Valley or San Francisco versus angels here, there are a good number of angels here that have a very small number of investments and that have fewer shots on goal, and so just aren't quite as up to speed on current market trends and therefore are resistant to things like safes. I mean, frankly, that tells you a little something about those investors. There are rationale. I represent a lot of investors, and so I've made the argument on the other side that no, we should absolutely have a note in these circumstances. There's reasons for it, but at a high level, that probably suggests that they're not super current with high volume investing. And Vancouver, conversely, is a little more upstarty, and so they're trying to be a little more like the Valley to try to leapfrog and catch back up. Whereas Seattle, we've got an ecosystem, we have a tech ecosystem, we have angel ecosystem, so people feel reasonably comfortable that they have enough deal flow that they can be a little bit demanding on terms and not have to fall in line with those sorts of Valley viewpoints. I think in terms of convincing people, it's tricky because, investors are the smartest people in the room. If Kurt was here, I'd tease him about that. They have the dollars, so they win. So it's hard to convince people that maybe they're, being a little archaic. But I think the way you want to talk to them about it is mutual alignment, like efficiency, keeping costs down. We all want your dollars to go as far as possible to grow this business and hit the home run. That type of language is the best way to convince them, but sometimes they're just not convincible. I won't name names, but there's investors in town that just won't do it. In terms of structuring your round in different geographies, it's a little tricky because if you do different structures, you're just going to run up legal bills to unreasonable levels for the dollars that you're bringing in the door. So unfortunately, you're a little bit stuck with the lowest common denominator and playing to the lowest common denominator terms, which is why leverage and shots on goal and maximizing your opportunities is probably the best you can do. So shooting in lots of different markets can be useful, not excluding yourself to Seattle, or I mean, not exclusively working in Seattle, because then you get a better chance of bringing in somebody that's going to anchor it and lead it on slightly more company favorable terms in a different market potentially. But again, I mean, I do, 75% of my work in Seattle. We have lots of investors here that are okay with safes. And, it's typically going to be people that are not just angels and that are venture investors or super angels that are investing out of the market as well as in the market that'll be comfortable with that. But all the venture firms, all the big 6 or so venture firms have all come around to and will invest in safes now. So they're not, and they've come earlier and earlier, and they won't lead, but they'll put some small bets to try to get a leg up to lead the Series A round. So it's not like Seattle is complete. 5 years ago, nobody in Seattle would invest in a safe, and that's evolved, and I expect that to continue to evolve unless we hit a big downturn and the leverage changes. Yep.
12:58.
Okay.
So.
One more?
Sure. Are there any more questions? Final questions? We're good?
He's got one right here.
Oh, yeah. Perfect.
Sure. So SAFE is a simple agreement for future equity. So are you familiar with the convertible note? Yep. So it's exactly like a convertible note, except for at maturity. So a note, it has a 1 or 2 year maturity date. And if you haven't done a financing or sold your company by that maturity date, the note becomes due and payable. Principal and interest is due back to the investor. The convertible security does not have that feature. So what happens at maturity? Some convertible notes have a convertible securities, which is a convertible note that doesn't have the note feature. Some convertible securities say at maturity you'll convert back into either common stock or the last round of preferred stock at a pre-agreed upon valuation. What the SAFE does is just say, no, we'll just have this piece of paper outstanding that says until you finance yourself, sell the business, or sort of liquidate and dissolve, this is going to be a promise for future equity. But on those 3 events, here's what happens. In a financing, they'll convert into the new round at either a discount or a valuation cap. In a sale event, they'll either get their money, the SAFE says you either get your money back, it's just 1x, or you convert back into common at a predetermined valuation cap. And in a liquidation, you get your money back behind creditors and debtors, but ahead of other equity holders. So 1x, in the middle of the stack. So the SAFE is just, like I said, it's a branded form of convertible security. And it's just called something different because Y Combinator created it and open sourced it and wanted to have a cool name for it. And the value of it is that it's open source, so it's become a market standard that everybody has access to and understands, and you can redline it against and say, see, we didn't change anything. All we did is fill in these 3 things, take it, we're all good, let's close our money and move on and build a business and not pay the asshole lawyers a bunch of money. Yeah.
Perfect. Is that all?
That's a
I think
perfect.
so.
That's a perfect note to end it on.
That is a perfect ending.
Yeah.
All right. Well, thanks, you guys. And yeah, again, perfect. And any questions for either of us? Yeah.
I can stick around for a few minutes if people have specific questions.
Perfect. Awesome. Thank you.
Thank you.
Thank you.